How are you? So welcome everybody. The values investing panel, we've got a tremendous group of friends and professionals here, and I'm going to let each of them introduce themselves and what they do. But the focus here really is that we think that we are going through a mega shift in terms of what's happening in the marketplace and where values are going to be created in terms of investment returns. And I said this in my talk this morning, but we really believe it's not just investing in businesses that have purpose and mission that because it feels good. I think it's where the greatest returns are. We think the greatest companies of tomorrow are going to have the ambition of a for-profit and the heart of a not-for-profit because it's these values that provide sustainability and ultimately growth. But with that, we have an incredible panel here, and I'll provide some more color on them in a second. But I'd like each to introduce themselves and kind of what they're doing. Jason.
Hi, I'm Jason Illian. I am the CEO and co-founder of a fund called Highmount Capital, and we invest in kind of Series A to C stage software companies. I was an entrepreneur for about 15 years, building software companies here in Dallas. Before that was cool. And then worked for a place out of Wichita, Kansas called Koch Industries, where we help build the growth and venture arm and put a few $1 billion to work in these types of companies.
He was captain of the TCU football team, and he was on The Bachelor.
And we were not supposed to share that.
I'm Cameron Chancey. I'm in commercial banking with First Horizon Bank, focused on M&A and sponsored transactions. Have been in the enterprise finance segment now for a handful of years, and I just have a passion for finding how we cross purpose and profits. I see this new wave of investing coming in and a new focus on investing in human capital, and really feel like that is where the future is going, and just excited to be a part and passionate about how we find a way to usher that in.
And played football at Missouri.
I did not play football anywhere except on the playground. So I'm David Spreng. I'm the founder, CEO, and CIO of Runway Growth Capital. We're based in Silicon Valley with offices in New York, Chicago, San Diego, Boston, and a one-man office here in Dallas. And we do not invest in equity, although that is my background for many years as a VC. We make loans as an alternative to equity to late-stage companies that want to avoid the dilution that comes with equity. So we'll lend between $10 and $100 million, generally to venture-backed companies, but they can be non-sponsored, they can also be PE-backed, and they can even be public. And that money is used to finance growth, with the one commonality that runs across all our companies is that they're pre-profit, but very much have a path to profitability. And I'll give one pro tip. If you have the choice, avoid putting CIO in your title. Because for us, that stands for Chief Investment Officer. But for every marketer in the world, it stands for Chief Information Officer. And I get like 100 emails a day trying to sell me software services. So if you want to keep your email clean, just keep CIO off your title.
So just a couple other things just to know about David. One, if you know the Forbes Midas list, which goes to, there's an annual list of the 100 top VCs in the world. David's been on that list multiple times. And he also has got a book that's coming out. Why don't you quickly talk about what the book is and where you can buy it?
It's called The Book That No One Will Ever Read, but Wiley is publishing it, and it's actually called All Money Is Not Created Equal, and it's a guide for entrepreneurs from somebody in their college dorm room to the latest stage venture on how to best capitalize your company. And of course, there's an angle in it about don't forget debt as an option, and it should be coming out in mid-July.
So why should an entrepreneur use debt as they're financing their business and their growth?
To avoid unnecessary dilution is the primary answer. The secondary answer is debt is cheaper than equity, and there's a whole raft of, subtopics under that, but a lot of it boils down to keeping ownership in the hands of the people that are driving value. And a lot of times we meet entrepreneurs who are frustrated by the small percentage of the company that they own by the time they exit. But what's really even more frustrating is the lack of control they have over the direction of their business when it comes time to sell it or not sell it, and also the influence they have once the company does exit. And for entrepreneurs, it's their baby, it's their life, and so owning a bigger percent of your own company is one of the biggest drivers for why people come to us.
Yeah, and you've done an amazing job. So Jason, talk about so you're an entrepreneur. You ran the venture business for Koch Industries. You've been involved in a lot of great businesses. So when we talk about values investing, why does that matter, and how do you look and evaluate a company that you're about to invest in?
Yeah, I mean, there's a couple of things that I think are really important. David hit on one of these, is when you think about the investing side of things, everybody's money is equally green, right? So anybody that can invest in you can put that money into your company. And we look at it as, how do you look for people that can actually add value and add significant input to your company? So as you think about the company, it's not just capital that you're lacking, it's knowledge, it's relationships, right? You're trying to create this flywheel effect of, yes, I need the capital to drive it, but I also need knowledge, relationships, and continue to iterate on that business plan to actually create something over time that will have significant impact in society. So at times that means giving up equity, because that means you are working with somebody that you believe is bringing more than just a check to the table. You should in this scenario. But in other times, I think it's a debt scenario where you said, we've got the right team, we understand our product market fit, and we've got to figure out how do we accelerate that. Sometimes debt's a fit. But I think it really comes back to, at the end of the day, when you're starting your company, what is your worldview? Like, what is your personal worldview? Meaning, we all have one. If you don't know what it is, you take some time to think about it, because some of us start from a political worldview, some of us start with an economic worldview, some of us start with a biblical worldview. But whatever that worldview is sets the foundation of how you build your company. And who you partner with should share those same vision and values. And when you do that, when you combine those types of things, then you're able to have truly significant impact. We always talk about the successes of the companies that you've invested in and you have, and I certainly know you have, but we often leave out the stories of disaster behind the scenes.
I haven't had those.
I know you haven't, but I'm talking about the rest of us on the panel. We'll work on your counseling later. But the reality is,
It's important to have no rear view mirror.
yeah. But the reality is in so many companies, the companies don't make it not because they don't have a good business plan or they don't even have a large addressable market. It's because they don't have an incentive aligned, and vision and value aligned team working with vision and value aligned investors. And what happens is it just creates chaos. And you see that through people that are suing each other, companies that are going under, people that are spending capital in the wrong way. And so setting that foundational base and having those vision and values, it's critically important.
So Cam, what does being a mission investor mean to you?
That's a great question, Mike. As we see the landscape shift from millennials, by 2025, millennials will be the majority of the workplace. There's a large shift from paycheck to purpose. And so what we feel like that means is, we're seeing a lot more of this generation of millennials looking for more than just a 9-to-5 clock in, clock out job where I'm doing that for my paycheck, and then after work I'm going to be involved with charities or with what I'm passionate about or this, that, and the other. And so we're seeing a combination of people looking for purpose inside of their jobs. And how do we marry that together with companies and organizations that are focused on changing the world for better? And so we want to see and invest in companies that are not successful and then looking to check the box of somewhat virtue signaling or something like that. We want to invest in the companies that are at their DNA and at their core focused on this framework of changing the world. And through human capital, which is one of the most valuable things that we can invest in, we want to see them doing that from the beginning and really defining what it means for their company to win and be successful. And so, for me, it's very important as we see that shift to be at the forefront of investing in those companies.
Well, I could just add a little bit to that from real life. I have 3 children in their mid-20s. And I can tell you they would far rather be poor and have meaning in their life than make a lot of money and feel like they're not doing anything impactful.
Yeah, and the data bears that out. So your kids aren't alone. That's
Yeah.
that's the shift. I call it the triple up shift,
Yep.
which is taking place. The triple up shift is the great founders and entrepreneurs today. They're going to opportunities where they feel what they're doing can make an impact for society and for the world in the future, and the talent and employees are going to those companies. Customers, and the data bears this out, want to buy from a company where their values are aligned with that company, and they'll pay a premium if that company has that alignment. And the third is this panel a little bit, which is the capital is flowing to those companies. Why? Because that's where the greatest returns are going to be and the greatest sustainable growth is.
Well, so I just want to say, if you're building a company that is truly differentiated and you know what it stands for, you're going to have people flocking to you. Because the next generation, they don't freaking know what they believe.
Yeah.
I mean, to be honest, if you talk to the average high school student or you talk to them, they're so inundated with social media and different media, and that you can throw out the term of ESG, or conscious capital. You can throw out 1,000 different terms. We're just changing terms on them.
Yeah.
They don't understand what they believe. So if you actually have a company that believes and stands for something, you may agree with it or disagree with it, but you're going to have the people that agree with you flocking to you, because so many companies are just changing the way they are to try to fit into culture versus standing for something. And when you actually stand for something and you look bold and courageous, people come to that. They want to be part of that. And I think that's important.
So, So I agree with that. I would just say the other side of that coin is these young people are very perceptive. And if you're the CEO trying to portray yourself as mission driven and you're not, and it's not authentic, they will see right through you.
100%.
In the age of social media, it's so easy for that instant gratification where companies just, on a certain month will fly a certain flag and then take it down and not be anything. So to your point, you can see right through authenticity, and it's that integrity. And from the top down is where we see mission-driven companies really being impactful, because you just can see through phony leaders and people who are doing it just for the likes and just for the attention, but where true impact is made is when there's authentic leadership at the helm.
Yeah, and I'm going to ask David in a second, but we just wrote a piece last week called Boom, Bust, Boom, which is, if you look at this, and again, what is a mission company? There's a number of different areas that kind of fit within this big umbrella. ESG is one of them. Double bottom line, impact, sustainability. All that, it's a big tent. But you look at the data with ESG, it's just been up and to the right, like a growth business for the last 6-7 years, and last year it just crashed. And it crashed for a variety of reasons. But it's a bear market, and a recession has a way of kind of separating the real people from the phonies. And so you're seeing a lot of people kind of flow away. But I think this underlying trend that's taking place, and just like we've seen a lot of other trends, is going to be bigger and better than even people can imagine. So David, you've lived and worked in Silicon Valley for now. We have basically the same history. We both grew up in.
Say, don't call me old.
Yeah, no, you are older than
Same
me.
age.
You're older than me by like 6 months. No. But so Dave and I both grew up in Minnesota. Went to the University of Minnesota. Started in the investment business. Found our way to Silicon Valley. You've been there for 30 years almost.
Yep.
So what do you see in Silicon Valley? We're talking kind of broad strokes here, but what do you see in Silicon Valley in terms of these trends and where talent's going and the kind of companies that you're looking to invest in? And how do you separate the people, as you said, that are authentic versus people that are just sort of saying it because they think it's what they're supposed to say?
Yeah, well, first I would say on that boom, bust, boom thing, almost every investment category went bust, you know, last year. So
That's true.
yeah, so and especially in the venture world. So I wouldn't write too much into that. And you know, I'm hopeful, kind of, I think Jason was alluding to this, is that we soon get to a day where there is really not that much of a difference between a mission-driven and any other kind of opportunity, because those are the ones that succeed.
Yeah, 100%.
Yeah. So, and you know, so we have a lot of ESG filters that go into our business. We don't take board seats, even though that used to be my role as a VC, is I would sit on every board I invested in. As a debt investor, we don't have that luxury. We don't have the time to do it. So we're really not in a position to make major changes once we've invested. So our role is mainly in filtering. So we will filter out any company that isn't highly already evolved towards being a good steward on ESG factors. And then, of course, the biggest input on any investment decision is the people. And to your point, it's pretty easy to tell a phony. And I have 2 chapters in my book on liars, bullshitters, and jerks. And
It says a lot that there's 2 chapters.
yeah, 2 chapters. Yeah, one from the investor perspective. How do we know if somebody is one of those? And then the other is from the entrepreneur's perspective. And you know, as Jason was saying, you really need to be aligned with your investors. This is, especially on the equity side, you're going to be together for a long, long time. And you know, it might not be a marriage, but it's close, and it's equally as expensive if it goes wrong. You know, the point is, you know, what do we look for? Genuine, authentic, world-class leaders that are looking to do something that's highly impactful. I would say we're not insistent on a company that's going to change the world. We don't need Facebook to make a very good debt return. That's not what we're looking for. We're just looking for genuine, honest people that will be transparent and communicate and do what they say they're going to do.
So just follow up, because not only you've been involved with Silicon Valley, you've lived there for 30 years almost. Yep. You've been involved with Davos for 25 years.
Yep.
So what do you see from the global business person's priorities, if you will, or philosophy that you know you think is just both a trend, and what do you think is sort of a fad?
So it's kind of interesting because I was involved with the World Economic Forum's effort in impact investing when they first moved it from the Schwab Foundation, which is like a charitable thing, to the investor group, which I was a part of. And smartly they said, okay, if this is really going to take off, it can't be viewed as charity. It's got to be viewed as a legitimate investment category. And the program, I guess, was called Mainstreaming Impact Investing. And it was really interesting. It got a lot of airtime. They put a lot of emphasis on it. And now, if you go to their website, you can barely find it. So I would say it's kind of run out of gas a little bit in that world leaders have bigger problems. You know, and this is not Jamie Dimon's biggest concern. Although, if you look at the number of assets that J.P. Morgan manages in impact investing, it's huge. And my wife works at Morgan Stanley, and I was looking at some of their stuff a couple days ago. It's insane how much capital they manage under the banner of impact or aligned investing. So I think the idea of mainstreaming impact investing has happened, partially thanks to you and efforts like this and what the World Economic Forum did. But for them, it's no longer their top priority.
So Jason, you had a pretty good gig seat at Coke, and now you started Highmount. Why'd you do that, and what's the difference? And start with that, and I got a few follow-ups.
Yeah, I mean, so there's kind of a mental model. I often think in frameworks and mental models, and I think most of us do. And one of the things we often think about is when you're building something, you can either build an empire or you can build a legacy, but you don't get to build both, right? And so when you look at a company or you look at investment houses, think, is it an empire or is it a legacy? The empire ones are built around a person or a brand, and when that person or brand is gone, it's gone. Legacy ones are built around this impact, this social ability to transcend just one generation and continue to have an impact on society and for eternity, right? And so, you know, Coke's great at a lot of things, but it's very economic thinking, right? And that's their primary purpose. And we had a great gig. And I think very highly of many of the people that I work with at Coke. But as I'd spent time there, I continued to have this conversation internally and with friends of saying, how do we build a firm that truly bakes impact into it so we don't actually have to say it, right? You just know that that's happening in everything that you do, from the people you hire to the companies that you invest in to how you help. Because at the end of the day, whether you sit on the board or you don't sit on the board, the best conversations happen on a Sunday afternoon when you call the CEO and ask how his family's doing, right? And you say, how you doing? And they just get to open up. Because our personal and our work lives aren't disparate, they're connected. And so being able to create an organization like Highmount and partner with, you know, investors, and this is to your point, David, earlier, is like having your investors on board and ones that are aligned with you, that see the world and want to have that same type of impact. Do we want to be the best investors on the planet at Highmount? Absolutely. In 10 years, I'd love for them to say Highmount, Sequoia, Andreesen, all of those in the same term. But if it's, well, I'm just, those are given. Those are given. But if it's just for economic impact, then we failed, right? Because there's lots of places we can go make money. And I hate to say it, but how many people in the past have you known that have made a lot of money and that's all they made, right? Their lives were a disaster. And Alexander the Great once said, when I die, let my hands hang outside my casket so that they see I take nothing with me. And so what are you leaving here that's more than just economic impact? Economic impact is part of it. But with that, there has to be additional value creation. And this is one of the things that we just got caught up in the last few years, and you guys mentioned this, is the reason that we had part of a correction is we were just investing in all sorts of things and forgetting about what was actually creating real value. And so part of the reason there's a crash is because we created it. We all got excited that everything was going to go up and to the right forever, and the young entrepreneurs for the last decade thinks every business plan I've seen is going to be $1 billion company, right? And we were just throwing money at it. And then we stopped and realized that something you've probably known all along, building businesses is really, really hard. And so to do something that's really, really hard, you have to have really, really good vision and value aligned people. And that was the impetus for creating Highmount, was saying, hey, we want to do that. And what we always say is, like, we have a fund, but we're really building a firm. The fund is a vehicle, but at the end of the day, we're building a firm. And with that firm, we want to add value to not only all of our investors, but we want to go out there and find those next generation companies that they don't have to be the next Facebook. What if they're changing their local community? What if they're changing things in that state? Those things will grow if they're seeded properly.
Yeah, and just as it relates to sort of the difficulty of building a business, I like to say, and that's what I talked about, having no rear view mirror. You know, the pain that goes on with starting a business, I think it's like being a growth investor. It's the pain that you experience if you have to remember that. It's like having a baby. Maybe I didn't have a baby, but
I didn't either.
You'd never have a second if you
Right.
remember how painful it was for the first, right?
Right.
And so it's painful to start a business.
Yeah, and most great investors and entrepreneurs, you learn more from their scars than their successes, right? You should go up and ask them, like, what are all your scars, or how many times did you almost miss payroll? How many family vacations did you miss, right? How many times did you have to stand in a room and separate the ones you're going to keep and the ones you're going to have to fire? Right? Because until you have a few of those moments, you don't really know what it's like to build a company. But once you do, then you start to realize which of my investors are with me. Like, who's going to walk with me through this? Because that's what life is about. It's about going through those things and coming out on the other side. And we're about to see that. We're about to see what's going to happen with this last generation of entrepreneurs, of who's going to come through kind of the difficult moments we're having now in the economy.
Well, I like to say it's a lot different when your name's on the front of a check than the back of the check. So let's talk about some war stories about companies that have thrived, and it's because what got them through some of these difficulties is because they had a core belief system, a core value system. And also talk about, and maybe you could each give sort of an example of a company that really nailed that, and then maybe example, you don't have to name the names, but maybe the characteristics of maybe what situation that didn't work out so good because they didn't have those core values. I'll start with you, David, because you looked the other way.
Yeah, I'm trying to avoid that. So the second part of that question, where they didn't have the core values, sometimes it's really not in their control. And I think right now one thing that's really important for entrepreneurs and everybody in this room to realize that things go in cycles. And the fact that venture investment is way, way down, and we're going to go into a period, it's happening now, of culling, where a lot of companies are going to fail. It is completely natural. It happens, I wouldn't say all the time, but it's a part of the venture cycle. And as Jason said, I think he was alluding to employees, but it's the same thing with the venture fund. They're lining up their 30 companies and saying, we don't have enough capital to feed all of our children. And we have to decide which ones are going to live and which are going to die. And if you get the phone call from your VCs saying, we love you, but we have no more money, you could be the most disciplined and purpose-driven and authentic leader in the world. And it would be very difficult to lead your way out of that. Now, I certainly can think of cases where we have dealt with people that are not honest, and are not genuine and not trustworthy, and do things that really aren't ethical in order to try to stay alive. And in some ways you can't really fault them, because if the alternative is death and having to terminate all your employees, you would do anything you can to try to keep your company alive. But I can think of one really good example on the first topic of a company that really was purpose-driven, was led by an extremely talented and hardworking CEO. And of course, it was the very first loan that we made at Runway. This is a curse in the venture business, is the first deal you do is gonna go bad. But it was a CEO that I had known before, and I had backed him as a VC, and he had a successful exit. And in any case, he was running this company, and the world changed very dramatically on him. And they also made an acquisition in a foreign country over our objections, and of course, completely screwed that up. And they bought stock. They ended up taking a lot of liabilities that they didn't know they were getting. And in any case, they ran out of cash. And at the same time they ran out of cash, they realized they needed to pivot from more of a hardware-driven business to a software business. And that's very difficult to pivot on no money. and so we and the VCs got together with the CEO, and he laid out a plan and said, this is going to be really hard, but I think I can lead my people through this. And he did. 5 years of patience on our part, which is not normal in the debt world. And 5 more years of support from the VC got it through, and we ended up selling the company at a profit, and the management team and the employees all did very well, and I think they're now continuing to build this business for a private equity firm.
And just to warn everybody, I'm going to start asking you guys for questions in a second. Keep on going.
I think I'm going to take a little bit different of approach, and I'll leave names out for everyone's sake, but culture is something that's really hard to cultivate. When you get a bunch of broken people in one organization that are relying on a paycheck, it's really difficult to find a mission that everyone's focused on. And it comes from the leadership, and so I've seen some really, really good, portrayals of that, and I've seen some really bad portrayals of that. And so, it's very clear when an organization is driven from the top down, and people are passionate about what they're doing, and it is almost contagious to everyone there. And so I saw that, and I saw people, there's a ton of ways to make money, and there's a ton of ways to be successful from what the world deems success. But it's about more than that. And so when everyone was locked in arms pushing on for this goal, it was incredible to see, how everyone from so many different walks of life were combined for one common goal, pushing to be the most trusted organization for different reasons, also, making money at the same time. But when that leader left, that culture was really difficult to maintain. When everyone wasn't focused on it, when the leadership wasn't focused on keeping that the main thing anymore, it fell to the side. And we really saw that echo throughout the organization where, you end up in turn, by not focusing on that, losing the most important thing to the company, which is the human capital and the people who are driving that company forward and making an impact. And when they lose the vision, when they lose the leadership, when they lose the culture that's been so hard and so desperately woven together with a unique purpose, when that's gone, it's like, hey, this is just another financial institution that I'm working at. I can do this anywhere. I probably need to find a new home. And so you've seen a lot of people leave from different organizations because of that. And so, I was involved there, and that was part of my story, is leaving because, the leadership change was just something that I no longer aligned with.
Yeah, so I think there's actually a couple things, characteristics you need to think about in advance. First is just the concept, and David, you brought this up, but the concept of stewardship. At the end of the day, when I talk to great investors or great companies, they often talk about they're just stewards, meaning it's not completely theirs, which automatically sets the tone that there's not a sense of pride there and it's not about them. And so great investors realize that's not all their money, it's somebody else's money that they're responsible for. And great leaders realize it's not their company, it's everybody's company that has a chance to have an impact. So stewardship is hugely important as you're thinking about this. And then there's bookends to this. When we talk about which companies are mission driven, you have to talk about, well, who started well and who ended well. Yeah. A lot of people start well, very few end well. Right? And they get lost somewhere along the way because pride, greed, all sorts of things, creep into your company. Actually, one of the biggest IPOs and most successful tech IPOs in the country came out of Dallas, and people don't even know about it. It's a company called SolarWinds. SolarWinds was here, right? Most people don't know because the CEO and the team didn't really care about being public faces. But they built a multi-billion-dollar company, and they were doing billions in revenue when they had less than 100 employees, right? And it was providing enterprise software to corporations in the late 90s, early 2000s, I think. You can correct me if I'm off on the dates, but it was based here. And to date, the CEO still lives here, and probably none of you know him. You know why? Because his main job is to give back to society, and he doesn't even really care whether you know him by name. There's so many organizations that he puts his money behind because he sees himself as a steward. And I've seen other ones that we've either had a chance to invest in or didn't invest in. So we met the Cullison brothers at Stripe early on, and there was something special about the way that they were thinking about changing the financial world for good and watching them grow. Now we'll see how that ends. We met the team at Databricks early on, and they were talking about data being the new gold and how do they build that, and that was when it was still a really young company, and now it'll probably go public north of 40 billion, $50 billion. And so these are companies that had baked some of this in. They started well. Now we're going to see whether they end well and whether they can continue that over time. And I think that's going to come down to the human capital. Like, how did they bake that into their company early on? And will that be able to transcend just the investment? And yeah, will a lot of people do financially well? Yes, but then what are they going to do with it, right? If that doesn't create this virtuous cycle of then them investing, that changes things. And so just one more example is when you go look at an ecosystem, why is Silicon Valley Silicon Valley? It's because they poured into each other for 50 years. Right, they were competitors, but they actually helped each other too, right? And you can go sit down at a coffee shop and you can see competing companies helping one another, thinking about how they're going to make an impact. And if you go to Boulder, Colorado as an example, Brad Feld basically planted that and created an ecosystem where he believed in giving first. And by giving first, the entrepreneur said, wait, If I give first, I actually get something in return over time, and it creates this very healthy ecosystem. And the question is, can Dallas do that as well? Dallas absolutely is and should do more of that.
Well, you made about a half a dozen amazing points.
This is where I drop the mic and just walk out.
You really should, because you made about a half a dozen amazing points. One thing I'll just follow up on, and you know, I think this has been a change in Silicon Valley. I mean, the culture in Silicon Valley for many, many years was that idea that if you get everything you want, if you help enough people get what they want. So I mentioned, if you heard my talk this morning, I mentioned a guy named Bill Campbell, who they call the coach of Silicon Valley. And they call him the coach of Silicon Valley because he was literally Steve Jobs' coach. He was Eric Schmidt's coach. He was Larry Page's coach. He was Jeff Bezos' coach. Mark Andreessen's coach. He basically created, they called him the $1 trillion coach. The book was written because of all the value he created. You had to fight to pay him for, pay him for anything. Or he said he wouldn't do anything unless he really cared about the people and what their mission was and who the people were. I mean, you couldn't bribe him for any amount of money. It was about paying it forward. It was about can I help these people? Everything kind of comes back in return. He did fine. He did extremely well. But it was all from this kind of mindset, this heart of giving. And I think that's what made Silicon Valley special in the early days, for sure. Questions?
Wait, can I just make one comment?
Yeah.
So I am old, and I've been around long enough to see at least 3 covers of Forbes or Fortune magazine say it's the end of Silicon Valley. And
I didn't say it was the end of Silicon Valley. I just moved.
Yeah, I know. I just would not bet on it. It will be different. And one thing that's already different is in the past, Silicon Valley was really the south of San Francisco, and it didn't include San Francisco. And I think today, the definition of Silicon Valley is the entire Bay Area. And I don't know if anyone saw it, but the Financial Times had a really awful article on what if the Bay Area doesn't come back, and they included all these probably artificially intelligence created images of iconic Bay Area landmarks in total disrepair. Like the Transamerica building almost falling down. So I'm not ready to predict the end of Silicon Valley.
But you hedged your bets. You opened an office in Dallas.
We have an office. Yeah, that's right. Yep. Just down the street.
All right, questions?
Okay, hi, my name is Myung-soo, came from South Korea. Actually, I want to listen about kind of the corporate venture capital, because the corporate has their own mission, their own vision to make make a better world. But I think when they do make an investment, actually it's kind of a bit more different from the impact. Some of them do impact investment, but some of them are just the mainstream is in the corporate venture capital. So how do you see that that make a difference?
Yeah, so I worked for, as you know, a very large CVC. And what I would say is most CVCs have an alignment that's strategic to them, right? They want to make investments that are helping whatever their core assets are. And through that, they hope that then that has an impact, right? And I think that's changing, because at the end of the day, to the points that we're making up here, is the next generation of workers want to have an impact in all that they do, and they want to have some definition as that. So I think the CVCs are trying to adapt to say, how do we continue to make investments in such a way that the people have ownership and aligned incentives? And I think the incentives are key here. Like, you have to align yourselves with the people that are actually making the investments in the companies you're investing in such a way that it's a high tide that raises all ships, not I win, you lose. And that often happens. And the running joke kind of in the Silicon Valley circles is when things get bad, the CVCs run for the hills, right? Like, they don't last through the cycles. I don't think that's the case anymore completely, but there is some truth to that, right? Because especially publicly traded companies, when things go bad in their markets and your stock's down, the first thing they're going to look at is what side projects do we have? And if these side projects are investing small amounts in small companies, you're the first one that's going to get cut. That's the first program. Well, guess what happened? You didn't just cut a program. You cut a program that invested in 50 other companies, and that creates a terrible brand image long term, right? So if a CVC is going to get into the business of investing in companies, they need to realize something. They're not investing in companies, they're investing in people. And those people all have phones. And those phones all have social media. And if all of a sudden a CVC that says, I'm going to back you for the next 10 years, calls one day and says, we changed our mind, they're not just going to tell one friend, they're going to tell 10,000 of their friends that you didn't live up to saying what you're going to do. And that's that sniff test for authenticity and transparency about really being real. So am I all for large companies getting into the business of seeding and helping others? Absolutely. But this isn't a 2-year plan or 5-year plan. They should know that that's a 50-year, 100-year plan to get into really investing in that generation. Because if not, it's going to create a backlash that it's going to be hard to recover from a human capital perspective.
But CVCs are an incredibly important and integral part of the overall ecosystem, much more than they were 20 years ago. And I totally agree with you, Jason. The old view was, we don't want them, they're not reliable, and they're probably just here to steal our ideas anyways. But there's been such a increase in the level of investment from CVCs and the value add and all that, it's a really big and important part. You know better than anybody.
It's growing, and it should, right? It should be an important part of the ecosystem because these are companies that have long-term cash flows. So they should be around pouring back into the ecosystem.
Logical buyers of those companies.
Yes, it makes a
It
lot
should
of
be
sense.
connected to Korea because they've got an incredible ecosystem there.
Yes,
They do.
indeed.
Provost.
So as we in higher education educate Gen Z and generations beyond, and you think of the impactful, successful people and those that have really focused on leaving the legacies as well, what do you see some of the key attributes that you'd like us to be thinking about with these generations to really move our world forward?
So I'll name a couple that I think are really important. Teachability. Are these students coming out, are they teachable? Are they adaptable? Because this is changing quickly. Like whatever I said at the beginning may not be good by the time I'm done today, right? And unselfish. Are they team players? There's nothing good in this life that happens because one person does it on their own. It is truly it is an ecosystem. We are connected to one another. And if they're not teachable, adaptable, and unselfish, they're not a good fit for these next generation companies, and because society needs those types of people. Now, the hard part for higher education is sometimes you're getting them after some damage has already been done. Like that's actually something that hopefully from birth is being taught from the home perspective and all the way up through K-12. But if they're not, then you have the fun job of deconstruction before the reconstruction of getting to that point so that they can be, helping members of society that help us flourish. And I think that there's a huge need for that to happen all the way from the home front, but certainly if they come to higher education, that has to be all the educational aspects of like information and all that, it's there, right? You can give them access to that, but these other key core traits and characteristics of, adaptability and unselfishness, right? Teachability, those are really important.
So 65% of college students say they want to work at a startup or start a company. And I have what I call the 7 C's that are what the core that people need, students need to know to not only start a company, but to thrive in the future. And one of them, by the way, coding is a fundamental skill, but it's one of the 7 C's isn't coding. It's communication. By the way, we have Roger Love here, who's the #1 speech coach in the world, helping the entrepreneurs at this at the Mission Summit with their speaking skills. But it's communication, it's creativity, it's collaboration, it's what's my 7 C's? Oh my gosh! Creativity, collaboration, critical thinking. It's civics, it's character. Characters. How do you teach character? Well, there's ways that we can develop that. So I think there's a mind shift that goes on in terms of the foundation of the skills that students need to thrive in the future.
And that character thing is, to Drew's point, is like, let them fail.
Yeah.
Like, we're too busy saving all of our kids from making little things. It's like, I just came back from my son's Little League game, and like, the 9th place team got a trophy. Are you kidding me? No, stop.
Yeah.
That's not how this works, right? Stop telling them like, hey, we're all winners. No, we're not, right? Like, it's okay that you didn't succeed. Work harder, train
You should
harder.
go to a karate tournament because there's more trophies than people.
Yeah, that's what I'm saying.
And I think one final piece to add to that is thoughtfulness. Jason touched on it earlier, but so many of our younger generations don't know what to think. And they're so easily moldable from social media in quick sound bites that they grab to and they formulate their entire foundation on nothing. And so, you know, seeing somebody who's thoughtful and really understanding, and it's okay to fail. You know, college is a time where a lot of us really figure out who we are, but really the ones that decide that they want to figure out what they believe, who they are, who they're going to be, are the ones that really become special leaders because they're not guided by the waves and the tidal waves of society. They know what they believe and they stand firm in that and stand firm in their convictions. And so I think that one's also really important in looking and identifying leaders.
I would just add to that. I think it can be a little bit dangerous when young people become ideologically stubborn and not open to even seeing somebody else's perspective. And I think that's something that we need to make sure kids coming out of college have. And it's been mentioned by everybody here this morning, but the idea of a win-win solution. There's too much, it's a I win and you lose. And you know, that was, as Michael said, one of the key elements of Silicon Valley in the early days. So again, I think really really important. And then, and I'm sure this is part of the curriculum today, but just asking why. You know, and just because somebody, including a professor, says it, doesn't mean it's right. And there's nothing wrong with asking why. And I think it's a trait for everybody, not just young people. So, you know, the good news is we have amazing young people that are coming out of college today, and so many of them want to come in and work at startups, and they are helping change the world. It is happening, and we're trying to amplify it.
Yeah. So we got 3 minutes left, so quick questions, quick answers. Please. Go ahead. Yep.
I'm Peter Amidu. I'm a student at Dallas Baptist. I have 2 questions. One, I'm sure it's different from person to person, and you just become this person, but like, what advice would you give straight out of college to people in their 20s trying to find a different use of recognition?
A quick answer? Best advice is get out there and get punched in the nose a few times and learn from it. I mean, I think the best thing you do is you learn, you iterate, you experience more, and you keep on going. I think it's all about getting experience and exposure, you know, in your young days. Second question, quick. Sorry.
What advice would you give, or what would you tell people on the outside of
Well, you're going to fail a lot. I think that's the #1 rule in anything, and failing forward is key. And this is one trait in Silicon Valley. I think it's overstated, though, you know, about, you know, failing is great. But the idea is not great, but as long as it's a learning experience and you fail forward and it makes you better at what you do, then you've benefited from it.
And get a mentor. Another question.
Well, and I just say one last thing. If something's true, no amount of criticism will change it, right? So if something's off, you'll find out by letting people hammer at it and get punch your nose. But if something's true, it doesn't matter how much criticism takes at it, and that's why having this open discussion should be fine. Because if you stand on truth, it doesn't matter the size of the storm; it's not going to change anything. And you'll find that by surrounding yourself with other like-minded people that you can respect and learn how they're thinking through it.
Last question. Who wants it? Okay, well, that's awesome. Thank you, everybody.
Thank you.
Thank you.
Terrific.
I appreciate it.